Principles of Accounting 1, Chapter 11. So we're going to talk about corporations in this chapter. Corporations are created by legal rights. So we have to incorporate, which is a law agreement that we create that says what the rights and privileges of the organization is, and its existence is separate from owners. An organization is its own entity separate from its owners. Corporate organizations can be privately held or publicly held. Publicly held corporations sell stock on the stock market, and that stock market, the shares give you a percentage of ownership in the corporation. Advantages of being a corporation are that they are a separate legal entity from their owners. They also have limited liability. So the corporation has liability, and liability does not go back to the owners like it does in a partnership or a single owner entity. Transferable ownership rights. That's through the purchase and sale of stock. So if I own stock in a corporation, I own a percentage of that company. If I sell stock, I have transferred my ownership rights to someone else. Corporations are also considered to have continuous life, part of the ongoing business historic accounting principle where we believe that the business is going to be a going concern and keep going. There's easier capital accumulation. So how corporations get capital or money is by selling stock. The disadvantages are government regulations for corporations and corporate taxations. Corporates are double taxed because they're taxed on their income and then they're also taxed on dividends for shareholders. A corporate form or governance structure is how they are set up and managed. So the stockholders are all of the individual owners of a corporation. So a corporation has as many owners as they have individual shareholders. Then a company has a board of directors. The board of directors is voted on by shareholders if those shares come with voting rights. The board of directors is then responsible for assigning who the president, vice president, CEO, CFO, and other officers of the company are. We then have all of the employees of the corporation that are hired and work for the corporation. The rights of stockholders are to vote at stockholder meetings, or you can register someone to vote for you as a proxy voter if you have to attend the meetings and you aren't able to physically attend them. You can sell stock. You can buy more stock. You can receive dividends if the company issues dividends. It's not a requirement of a company to issue dividends. And you share in any assets remaining after creditors are paid in a liquidation. So if a corporation decides to no longer function and they liquidate or declare bankruptcy or end their company, sell off all of their possessions, after any liabilities are paid, the remaining assets are divided among the shareholders based on their percentage of ownership. This is an example of what a stock certificate might look like. So when stocks are sold, the stockholder signs a transfer endorsement on the back of the stock certificate. If you have physical stock certificates, a lot of stock anymore is sold electronically, and we don't have physical shares of stock that we would keep in our house like this. I'm always entertained by the fact that they use Green Bay Packers stock because Green Bay Packers stock is actually not traded publicly. It's only sold very rarely. In fact, they've only had one sale of stock in the last like 25 years. And it's very difficult to transfer Green Bay Packers stock if you own it. They prefer it be left in your will to a family member. And if you decide to sell it, you actually have to go to the board of directors for Green Bay and get permission to sell it. And you already have to have a buyer lined up that agrees to buy the stock. And the board of directors for the Green Bay Packers stock has to approve both the sale and the buyer of the transfer. So it doesn't work like traditional stock. Um, so I'm always amused that they use this as an example of stock in the textbook. When we're a corporation, we are authorized so many shares for sale. So we create a legal document through the SEC, which authorizes trading on the stock market, and we say that we would like to issue stock. When we issue stock, it's called going public. So the SEC comes back, and as part of that transaction process, we're told how many shares we are authorized to sell. So this example, we have that we are authorized to sell 250 million shares of stock. What we currently have issued and outstanding are 92,556,295 shares. So that's the total amount of stock that is currently sold and out on the market being traded. Our common stock par value in this case is 1 cent. So the par value gets set during the time that we're creating this legal agreement to sell stock. The par value does not equal the market value. It's just the face value of the stock that at authorization. So when we look at this, par value does not equal market price. Market price is the amount that each share of stock sells for in the market. Par value is an arbitrary amount assigned to each share of stock when it is issued. Generally $1. The most common par value is $1. Classes of stock are ones with a par value, which have a par value of 1 or a penny or $5 or some number that they picked. A no par value stock, where no par value was selected when the stock was issued, and a stated value stock, where we just say the stated value of this stock is $10 or $15 or $20. Our stockholders' equity is a total of the paid in or contributed capital. So this is the cash and other assets the company receives in exchange for stock, and any retained earnings that we haven't distributed out as dividends. So what is our cumulative net income or loss? When we issue stock, we sell that stock. So here we have par value stock. We have $10 par value stock. When we issue 30,000 shares, we receive cash of $300,000. And we record that we have common stock at a $10 par value of $300,000. If we sell stock for over the amount of our par value, that the amount that is over the amount of our par value gets recorded in an account called paid in capital in excess of par value common stock. So in this example, our common stock par value is $10 per share, and we have sold the stock for $12 per share. So anything over that $10 per share par value gets recorded and paid in capital in excess of par value. When we look at our stockholders' equity section on our balance sheet, then we see that we have common stock. We are authorized to sell 50,000 shares. We have 30,000 shares issued and outstanding, and we were paid in capital in excess of par on those shares. We also have retained earnings from previous years that gives us our total stockholders' equity. If we sell no par value stock, then we just receive cash and record the common stock at that amount. So we don't have the additional paid in capital account if we have a zero par value stock. If we have stated value stock, then we record in the common stock account the stock at its stated value, and then we record anything paid over the stated value at the paid in capital in excess of stated value common stock. One of the things that's important to remember is that the corporation only gets the cash at the first time the stock is sold. So this is the first time the stock is issued onto the stock exchange. If I own a stock and sell it to another person, I receive the cash for that sale and not the corporation. So the corporation receives stock when they sell it for the first time, but then when it gets publicly traded, the cash is transferred between the old owner and the new owner and doesn't go to the corporation. So sometimes that gets confusing when we think, okay, their stock is now trading at, they sold it for $40 a share and now it's trading at $200 per share. They must have all of this money. The corporation just received the $40 a share when it was first sold, and the stock owner is the one who received the increase in the sale. We can also issue stock for non-cash assets. So in this example, we have issued shares of stock in exchange for a land transaction. So instead of receiving cash, we've received land. So we have $20 par value stock, and we exchanged 4,000 shares of land, or 4,000 shares for this land. So we would have 80,000 in common stock and then 25,000 in additional paid in capital. If we are looking at par value stock and non-cash assets, so in this example, we are paying people for work. So we have some people who have done some work for us or services, and they've agreed to be paid in shares of stock instead of in cash. Therefore, we record a expense. So we have an organization expense in that we're paying people for their work, and the payment instead of cash was shares of stock that we issued to those people.